Welcome to FACT's webinar called Tax Tips for Livestock Farmers. Our presenter is Tina Salandra. This webinar is hosted by Food Animal Concerns Trust, and I am Larissa McKenna, FACT's Humane Farming Program Director. I'll be moderating the webinar this afternoon. Thank you all for joining us today. To begin with just a few quick introductions, FACT is a national nonprofit organization that's headquartered in Illinois. We promote the safe and humane production of meat, milk, and eggs. I direct FACT's Humane Farming Program, which provides a number of opportunities for livestock and poultry farmers. This webinar is part of our Humane Farming webinar series. Please visit our website to learn more about all of our farmer services, including some more of the webinars that we have coming up this winter. So at this time, I am delighted to introduce our presenter today, Tina Salandra. Tina is a principal at Numerical, a tax firm based in New York City. Tina has over 20 years of experience in tax and accounting services, and she has taught courses on business startup, essentials, and tax law. We are particularly lucky because Tina has served on FACT's board of directors since 2012. She currently serves as FACT's board treasurer, and we are very grateful for her guidance, leadership, and support that she's given us over the years. So we're really honored to have Tina with us today to share her experience and her expertise on all things tax related. She will be available to answer your questions later on in the webinar. So with that, I'm going to hand the virtual mic over to Tina so that she may get started with her presentation. Tina, please take it away.
Hello from New York City. Certainly an unusual location for a webinar related to farming. And with everything New York's known for, I am currently having some technical difficulties. I've gotten disconnected, but Larissa, I can go forward as long as you want to advance some of the screens for me, which I can't currently see at the moment. So I apologize to all of you, but that actually shouldn't affect my presentation to you because I have it in hand.
That's fine, Tina. Just let me know when you're ready to proceed.
I did read the poll results, so I was actually very impressed to see that more than half of you prepare your own income tax returns. Bravo, especially as we have had a very enormous tax law change here in 2018. And I'm going to go over some of those general changes for those of you that do prepare your own tax returns, because I think that's very important. And I would assume that if you prepare your own tax returns, those are the people who responded, they're familiar with Schedule F. For those of you that don't prepare your own tax returns, Schedule F is really probably the most important aspect of your tax return. So if you have a professional preparing your tax return, I highly recommend you request that tax professional review Schedule F for you, because that is your farming profit and loss. And so that has really all the operations of your farming business go on Schedule F, or virtually all of them. But before I get started with the specifics of the tax law to farming, I'd like to go over a summary of some of the changes of the new 2018 tax law.
So I'm going to.
Can you hear me? Larissa, can you hear me?
I can hear you now. Yep.
Okay, great. Sorry. And I think I'm back online, so let me try to advance the screen from the 2018 new tax law. So I'm going to start out with a summary of some of the personal changes that have been eliminated in this new tax law. My screen is not advancing, so I'll ask you to do that for me, Larissa.
Tina, we are on the eliminated screen.
Okay, great. So if you look at what's been eliminated, one of the significant items that no longer exists are personal exemptions. Now, in 2017, personal exemptions were $4,050 per person. So if you have a family of 4, you had deductions of over $16,000 on your tax return in 2017 that you will not have in 2018. So that may be significant for a lot of individuals, but it also will depend on some of the other factors. For those that are employees, meaning they work for somebody else, employees can no longer deduct business expense deductions or job hunting deductions. But for other individuals, if you have investment fees, if you see an investment advisor or a broker, or you have stockbroker fees, or if you pay to have your tax return prepared, you can no longer deduct that as a personal expense. However, the tax return preparation cost may still be able to be deducted on your Schedule F. So that's good news for farmers who are self-employed or have a business entity. Again, moving expense pertain to employees, so people that moved from one city or location to another for a brand new job can no longer deduct that expense. If you have a home equity loan or a home equity line of credit, the interest on that deduction is no longer available. And if you are getting divorced in 2019, I hope that's not affecting too many of the people on this call. If you have to pay alimony, you can no longer deduct that as an expense, but if you receive alimony, you also don't have to claim that as income. So that's a significant change to people in tax law, and the reason they made this particular change not starting until 2019 is because they realized a lot of individuals may have been in the midst of negotiating their divorce when the tax law changed, and they didn't want to cause more personal strife than people getting divorced are already dealing with. So the next screen would be what's limited. So what's been limited is also significant in the new tax law, and for those of you that live in states with fairly high either state income tax and or real estate taxes, the combination of those two taxes have been limited to only $10,000 of deduction. So if your home has real estate taxes of $7,000 and let's say you have income tax of $5,000, that totals $12,000. You can only deduct up to $10,000 of that now on your tax return. Real estate taxes for your farm are in a different category, so that's not part of this limitation. Mortgage interest for home mortgages, the interest deduction on the debt is now limited to $750,000 of mortgage debt. It used to be $1 million, and that debt could either be on your first home and or two homes combined, a first and second home. So next screen. What's been expanded in the new tax law is pretty significant for families. The child tax credit has been doubled from $1,000 to $2,000 per child. But in addition to doubling the amount of the tax credit, they have raised the threshold for people that can avail themselves of this credit. If you are married filing jointly, you can take this child tax credit with incomes up to $400,000. And if you're single or head of household, it's up to $200,000. So the income threshold has also more than doubled, and that's very significant for families. And let me also say the difference between a tax credit and a tax deduction. Tax credits are far more valuable because a tax credit is dollar-for-dollar deduction off your taxes, where a tax deduction is a dollar-for-dollar deduction off your income, which only gives you a percentage benefit on taxes. So the fact that the child tax credit doubled is really a great situation for families. Also doubled was the standard deduction. It went from about $6,000 and change for single people to $12,000, and the same for married filing jointly. It went from $12,500 to $24,000. However, because the standard deduction has doubled, it may knock out some of the other deductions you're used to taking. For example, if you're used to getting a deduction for charity, such as giving money to FACT. It may be a little more difficult if you're married filing jointly, if you're limited to $10,000 for your state taxes, and let's say your mortgage interest comes to about $10,000 a year. Well, that only totals up to $20,000. So in that case, you're going to want to take the standard deduction of $24,000. So even if you, let's say, contributed $500 to charity, you're really no longer going to get the tax benefit directly to that unless your other deductions exceed the standard of either $12,000 or $24,000. Medical expenses are still allowable as an itemized deduction, but they need to exceed a certain threshold before you can deduct them. The threshold used to be 10%. It's now been reduced to 7.5% of your adjusted gross income. But what that means is, for example, to say it in a simple way, if you make $100,000, the first $7,500 of out-of-pocket medical expenses are not deductible. It would only be the amount of out-of-pocket expense that exceeds that 7.5% of your income. But that includes lots of things besides direct payments to doctors. It includes your health insurance, and it includes travel to and from doctors and prescriptions and so on. The other item that has been significantly expanded in the new tax law are charitable donations. Charitable donations can now be deducted up to 60% of your adjusted gross income. I don't really know many people out there that give 60% of their income to charity, but if you are so inclined to have a windfall and give that much, again, think of FACT and other such charities for this deduction. So let's talk about what continues now in the tax law, meaning what hasn't been changed with the new tax law. Alternative minimum tax, that was supposed to be eliminated, and it has not been, unfortunately. But they did make the threshold for incomes that are hit with alternative minimum tax much higher. So if any of you had been subject to alternative minimum tax in the past, you are not likely to be subject to it with the new 2018 tax law. The 3.8% net investment income tax also remains in the tax law. This 3.8% only applies when you're single and your income exceeds $200,000, or if you're married filing jointly, your income exceeds $250,000. And it's on other than income. It's on dividends, capital gains, rental property income, and any other investments. This tax was really tied to Obamacare. It is supposed to be part of what funded Obamacare. And if there's a cutback on Obamacare, hopefully not, it seems not likely this piece of the tax that was really meant to fund that would go away. The 20% capital gain rate has also continued in the new tax law, but that doesn't apply until incomes hit way over $4,000, whether $400,000, whether you're single or married filing jointly. Fortunately, the home sale gain exclusion was not canceled in this new tax law. There was talk about that, but what this benefit is if you sell your home, your primary residence, and if you're married filing jointly, you can deduct up to $500,000 of any gain on that sale. I mean, for many individuals in many parts of the country, except New York City and maybe Chicago and Los Angeles, that completely gets rid of any taxable gain on your home, which is really terrific. And it's one of the only places in the tax code that what you're essentially able to do is take $500,000 of income and put that in your pocket tax-free should you sell your home. And you don't have to, it's not about buying another home, and you can actually take this benefit every 2 years. It's not a once-in-a-lifetime type of benefit. Also, what continues and remains in place in the new tax law are all the retirement contributions, which are pretty important. There was at one point talk that they would eliminate these, fortunately, that's not been the case. So if you have a solo 401k type deduction for your retirement income, you can still take $18,500 deduction in calendar year 2018. IRA deductions are still at $5,500 for both the 401k and the IRA. If you're over 50, there's certainly catch-up contributions. And also the SEP retirement contribution, which stands for self-employed pension. So that's a really great retirement option for self-employed people such as farmers. You can take a deduction and make a contribution of up to 20% of your business income. So if your net farm income is $100,000, you can contribute $20,000 to an SET retirement plan, and you can also take that $20,000 and deduct it from your federal and state income taxes. So SEPs are really a great way to contribute to your retirement when you're self-employed. So now let's just take a quick look at the new tax rates. On the right hand of your screen, or I'm sorry, on the left hand of your screen are the old tax rates for 2017 and 2018. New tax rates are on the right-hand side. I mean, you can see the numbers, the percentages for the new tax rates are all lower, which really looks great at a glance. But it's a little bit deceiving because, as I mentioned, there's a number of things that have been eliminated that are deductions in the new tax law that you can no longer take. So whether or not you'll benefit from the new tax rates also has to do with other factors such as itemized deductions and personal exemptions. So it's really hard to tell anyone at a glance that, oh, you'll definitely benefit from the new lower tax rates, or, oh, because, you know, you've had all your state and local income tax deductions taken away, you're not going to really benefit from this. So it remains to be seen. I know for my clients in places like New York City and California and Illinois, the tax rates are high, and those individuals are really going to feel probably that they'll pay higher taxes in 2018 because they're losing those itemized deductions along with the exemptions. So now let's talk about farming. There are 9 things that the IRS wants you to know about farming, which when the IRS says that, it's usually a double-edged sword. They do endeavor to be helpful, and they want you to know things that will benefit you on your tax return, but they also want to convey things that they want to make sure you do include on your tax return as they require. So the first item is valuation of animals. So the valuation of animals on your tax return depends on the animal and its use. Livestock that's purchased for resale, such as cattle, hogs, sheep, goats, horses, the cost of those animals are not deducted until the year you sell it. So if you buy a head of cattle in December 2018 and you don't sell that cattle until January 2020, a little more than a year from now, you have to wait until you do your tax return for 2020, which will really be in calendar year 2021, before you can deduct the cost that you paid for that head of cattle in 2018. So, but it really ultimately makes sense to tie the cost of your livestock to the same year that you're making money on selling it. That way you have less of a gain. And you can also include in the cost of the livestock the freight that you have to spend to transport it from your farm to the vendor that's purchasing it. If your livestock is dairy, you have to capitalize and depreciate dairy cows. So that lifespan of a dairy cow seems to average, according to tax law, between 3 and 5 years. And the good news is you have a choice of what depreciation you choose. Now, you can't choose it per cow. It has to be for your entire stock. But what you choose should be something you plan with your tax preparer, because the level of depreciation you take can make a difference on your ultimate net income from farming. And then hens and baby chicks are expensed in the year that they are purchased. So the year you purchase them is you take the cost right as an expense on Schedule F in that same year. So weather-related sales, if you are forced to sell livestock or poultry because of some weather calamity, whether it's flood or unusual low temperatures, you may be able to postpone the gain from selling other animals in that year, because the sale of animals that are because of some weather-related situation means you sold those animals before you would normally have, so you would likely have more income from the sale of animals in an extraordinary way than you would in another year. So the IRS is looking to give farmers a break if they have high income from selling animals that they were forced to because of an unusual weather-related condition. Farm income averaging is another possibility that farmers can use when they have a year where, for one reason or another, the farm income is particularly high compared to the prior 3 years where the income was low. So they don't want farmers, they meaning the IRS and Congress, don't want you to go into shock from suddenly owing a lot of tax because your income was unusually high in the current year when it had been low in the prior years. So they allow you to use the 3 years of income towards a calculation of averaging your income for the current year to make your tax hit a little bit lower in the current year. You won't be able to go back and change tax in the prior years, but it is something that the IRS allows that gives farmers a bit of a break when they have an unusual circumstance with high income in a particular year. If you receive rent for the use of your farmlands, if you rent out part of your barn to someone else, or you rent out part of your property to another farmer to plant or have grazing, that rental income is not farming income necessarily. That is actually just considered rental income, and it's reported on Schedule C of your tax return. I'm sorry, I said C. Schedule E as in Edward, and not on Schedule F as farming income. One of the benefits of reporting this rental income on Schedule E as opposed to F is income on Schedule E is not subject to Social Security tax, because rental income is considered passive, and farming income is considered active, and so your net farming income is going to be subject to Social Security tax. Rental income is not. Next screen, operating loss. So if you have an operating loss from your farm operations in the current year, you can deduct it, and if that loss is greater than all your other income, let's say income, maybe your spouse has wage income working somewhere else, and or you have investment income, that loss from farming can offset that other income in the current year. But if the loss from farming exceeds your current year income, the excess loss can be carried forward to future tax years. So that can be very helpful in the next year, when perhaps that farming loss was a timing issue or an unusual circumstance, and maybe the next year your income goes way up. Having a loss from the prior year to carry forward will reduce your tax, so that'll be it'll be a good tax benefit to be able to carry forward that loss. It seems I lost my it seems I lost my connection again. So Larissa, I'm going to the next screen, which is insurance proceeds.
Yes, we're on insurance proceeds.
Okay. So if you receive insurance payment for the loss of livestock that was for resale, those insurance payments equal income. It's as if you made income from selling the livestock as opposed to having a loss from that livestock. Those insurance payments are treated the same as if you sold it. So that is reported on Schedule F as regular farm income, and it's subject to all the other taxes that farm income is. The next screen, expenses. So also on Schedule F, you can deduct all other expenses that are ordinary and necessary. That is an IRS term, ordinary and necessary, and it basically means expenses that are simply common accepted in farming operations. An example of that would be seeds and fertilizers and having to buy fuels and perhaps some storage, repair and maintenance. What is not ordinary and necessary, perhaps you decided you would buy a new luxury vehicle in addition to your tractor and your truck. The IRS might not say that's typical to farming, and it's not deductible. Things such as farming attire. Attire is a funny word. Generally, the IRS does not allow any deduction for clothing. So when I come to the office every day and I buy suits that are specific to that, and I generally don't wear those suits anywhere else but the office, nonetheless, I cannot deduct my business suits as clothing for a particular business. But farmers, it's different because you may have to have particular shoes. Maybe your boots are steel-toe boots. And that would make them particular to farming, and they are deductible. If you buy overalls, overalls are not considered regular clothing that you would wear out to a nice restaurant for dinner. So that kind of clothing is deductible for farmers. So farmers have a big advantage over anyone that's an employee, office worker. Farmers can generally deduct clothing used in farming where other people cannot. The next screen, hired labor. If you hire labor to work on your farm, if it's an individual, generally you have to treat that individual as an employee. And that means you have to withhold taxes, particularly Social Security and Medicare taxes, but in addition, state and federal income taxes should be withheld, and you would provide that person a W-2. If that hired help really has their own business and they provide something specialized to your farm, perhaps you hired someone that's a specialist in breeding, and they have their own business, and they go to many farms and provide these breeding services. That's not considered hired labor in the same way, and you would not make that person an employee and withhold taxes, but you would likely have to still give that breeder and or his business Form 1099 at the end of the year to say that you did pay them a certain amount, which is still deductible. If you hire your child to work on your farm and that child is under 18 years of age, you do not have to withhold Social Security tax or Medicare tax for them. And chances are, if that child's income that you pay them is under the standard deduction and they would file their own tax return, you probably don't have to withhold federal tax or state and local tax either. So hiring your children can be a good thing for both the family, and it is deductible expense even though they're your child. And another tax tip, when you do hire your child, if they have earned income, they can then contribute to a regular IRA or a Roth IRA account, and that's a really good tax planning strategy for people with children, because the sooner you get started on something like a Roth IRA contribution, that will then grow for the rest of their life, and when they take it out, it's all tax-free. So Next screen is fuel tax. So you can take a credit on your Schedule F, on Schedule 1040, but it relates to the fuel federal excise tax that you're paying on fuels that you use in your farm. So if you buy diesel fuel for your tractor, if you have certain heating oils or other fuels that you use on your farm or to keep your barn warm, the portion that you pay for that fuel tax includes federal excise tax, and that federal excise tax is a tax credit to farmers. It's not to most other businesses in the U.S., but farmers have that advantage. So that's another place that the tax code favors farmers in a positive way. The next screen is just giving you a quick summary on when you might use Schedule F versus Form 4797 for sales of farm products. So if you're selling a farm product that you raise for sale, like livestock or crops, you're going to report that sale on your Schedule F as regular farm income. Also, if you sell products that you bought for resale, such as, again, livestock, as opposed to livestock raised for resale, some farmers may buy livestock with the intent of turning around and reselling it in less than a year, which makes it livestock for resale. That is also reported on Schedule F. However, if you sell assets that are considered capital assets, and examples of those would be dairy cows. So if your business is a dairy farming business, you're not in the business per se of selling dairy cows, you're in the business of selling dairy products from that cow. But when you do sell a dairy cow, that's considered a capital asset, and that would be reported on Form 4797, as would sales of livestock that you hold for breeding or draft or sport. And it also includes equipment, not just livestock. So if you buy a tractor and you sell that tractor, you're going to report the sale of that tractor on Form 4797, because presumably you're not in the business of selling tractors, you're in the business of farming. So the tractor is just one of your capital assets, but it's not what your business is. Next screen. Leasing farm property and equipment. That would be machinery, trucks, incubators. If you have to lease and or rent any of this equipment, that is reported as an expense on Schedule F. However, if you lease or rent your farmhouse that you live in, even though that farmhouse is squarely on your farm property, that is a personal expense, and that is not deductible anywhere. Next screen. Home office. But if you do have a home on or near your farm property, whether or not you own or rent that home, you can still take a portion of that home that you use for your home office to either do billing or invoicing or other administrative work related to your farm operations. The portion of your home that is your home office is a deductible expense on Schedule F. And home office deductions would be, let's say, 10% of your home is used as a home office. That would mean 10% of your mortgage interest is deductible, 10% of your real estate tax, your utilities, your repair and maintenance on that home, your insurance. All of those expenses for your home would be deductible in proportion to what part of it is the home office. And if you rent the home, you simply can deduct a portion of the rent as your home office expense, in addition to utilities, repair and maintenance, and insurance. Next slide, tenant housing. If you provide housing for your hired help, you can deduct the cost of that housing as a farm expense. in addition to just the cost of that housing, the cost would include repair and maintenance, utilities, insurance, depreciation, as well as furnishings that you may provide for those that live there. Next screen. Depreciation of livestock. Depreciation of livestock certainly varies, again, depending on what type of livestock, but it has to be livestock that's not considered inventory. So livestock for resale is usually considered inventory, so that would not be depreciated. But a dairy cow, for example, would be subject to depreciation. And again, I think I mentioned this earlier in the presentation, the depreciation that you take on that dairy cow could be somewhere between 3 and 5 years, and that is up to the individual farmer to decide what level of depreciation they want to take for how many years. And again, as I said, livestock that's raised cannot be depreciated. It's part of inventory, and what your cost of raising that livestock continue to be deductible expenses every year, so there really isn't a depreciation factor in livestock that's raised. And last screen is entity choice. I have 3 entities on here. There really should be 4, because the first entity, which a lot of you probably have for your farm, is simply that of a sole proprietor, meaning you simply own the farm under your own name. And you, as I have been talking about Schedule F, you've been reporting all the income and expenses on Schedule F. If you form your business as an LLC, a limited liability company, and you are the only owner of that LLC, and or you and your spouse jointly as one tax person, that would be considered a single member LLC, and the IRS essentially disregards it as an entity, meaning you still take all of your farm income and expenses and you continue to report them on Schedule F as if you were a sole proprietor. So there's no real difference between a single member LLC and a sole proprietorship for tax purposes. Where there is a difference, and why some people may choose to become a limited liability company, even if they're a single member, it's what the very name indicates. Your liability is what would be limited, presumably, if you have an LLC. So if something terrible happened and one of your vendors or your clients sued you for any reason, if you are a limited liability company, they cannot technically sue you for more than the asset value in that limited liability company, meaning your farm itself and your farm assets, but your home, for example, would be outside of your farm assets. So they couldn't sue you and be able to take your personal home away from you. But if you're a sole proprietor, everything you own is open to liability. So if there is some sort of trouble on your farm, you could actually lose your home or your personal car or other personal assets if you're a sole proprietor as compared to an LLC. An S Corp is actually a corporation, and the word S truly came from small. It's a small corporation. That was intended when that name was given to it. An S corporation is considered a pass-through entity. So the income you make from an S corporation from your farming operation is then not taxed at the corporate level. It is passed through to your personal income tax return, and you simply pay tax at regular income tax rates as if essentially you were running that as a sole proprietor. Again, what an S corporation provides for you is a limited liability, and an S corporation is also a good choice when the farm is owned by multiple people that are other than spouses. So if you have business partners, essentially an LLC or an S corporation is probably going to be one of your likely choices for entity for your farming operation. But from an income standpoint, the income from an LLC and an S Corp is treated the same to you personally as if you were simply self-employed as a sole proprietor. C corporations are the only entity that is really treated and taxed differently. Many of you have probably heard a lot of the talk about this enormous deduction in C corporation tax rates. And it is true that where the C corporations used to have a tax rate of up to 35%, it has now dropped to 21%. And a lot of my clients that are not farmers have all asked me, wow, I'm going to form a C corporation because now I'll only pay 21% tax. Isn't that great? Well, the difference with a C corporation is the corporation itself gets taxed and is subject to tax at the corporate level, but now you as the owner shareholder of that corporation want to avail yourself of the income that you've earned through that corporation. You will then pay tax a second time on that income from the C corporation. So I'm going to give you a quick example, and I'm going to purposely make it simple so it makes clear why you might not want to be a C corporation. Your net farming income is $100,000, and let's say you even live in a state where there is no state income tax. So now there's 21% tax on your corporate farm income. So that's $21,000. You are now left with $79,000 after taxes. Well, you want that $79,000 to live on because, well, you're the only owner of this C Corp, and that's what you depend on for your income. You can avail yourself of that $79,000, but that's going to be distributed to you as dividends. Dividends are subject to tax. While you will only pay 15% tax likely, it could be 20% if your income is very high, but for this example, let's say you're going to pay 15% on those dividends. Now you've already paid 21%, you're going to pay another 15%. Your total federal tax rate on that $100,000 just went up to 36%. If you made $100,000 and you were a sole proprietor, your tax rate would only be 22%. So it's not a good deal from a tax standpoint to necessarily make your farm as a C Corp. There are some tricks of the trade that can make it worthwhile for certain businesses, including farming, but as a general rule, for small farmers, C Corp is not usually a good choice. So that's my presentation. I know I probably went a little bit fast with all the information we covered, but I am happy to now take any questions that, Larissa, I'm going to have to depend on you to read them to me since I had lost connection here.
Absolutely. Thank you so much, Tina. That was really fantastic. We've had a bunch of questions roll in already. If people do have other questions, please type them into the sidebar, that chat screen on the left, and we're going to read the questions out loud so you can hear them, and then Tina will answer them. If we don't get to all the questions, we will provide an opportunity for follow-up later because we have about 10 minutes to do Q&A. So the first question is, would you please expand on the statement for eliminated tax deductions? This goes back to the earlier part of the presentation. No employee business expense deduction. Does this include reimbursed mileage for employees?
It does, but essentially, if the mileage is reimbursed, they can't deduct it. So you can't do it both ways. So if you're paying, if you have hired help in the farm and you agree to reimburse that person for the travel time it took them or for using their truck to cart the livestock to the buyer, if you reimburse that person for their expense, that employee cannot deduct that travel expense, but the farmer still can. That's still a valid expense on Schedule F for farming operation.
Thank you for that. We had a couple of questions. I'm going to combine them about the SEP. Can you say the acronym again, Tina? What does SEP stand for?
SEP is self-employed pension.
Pension.
It's actually my favorite pension plan out there for people that have their own business.
So are there rules? There's a two-part question. Are there rules for employees, and does it also apply to LLCs?
The first answer is if the farmer has employees, an SEP is not a great option in that you have to provide your employees with the same benefit the owner farmer will take himself. So, for example, if the owner of the business, the farmer, wants to take a 20% deduction and contribute 20% of their income to an SEP, the farmer then has to contribute 20% of their employees' income for their retirement plan. So when you have a lot of employees, a self-employed pension plan, an SEP, is not a great choice.
And
Was
that
there a second part of
there
that?
was,
I didn't answer.
it was about, does it apply to an LLC? Are there any other restrictions about that?
There are not. If you have LLC income that's earned income, you can definitely take an SEP deduction and make a contribution based on your LLC income.
Thank you for that. Another question we have, and this goes back to that tax chart with the different rates. For example, if we make $200,000, will the income above $157,000 be taxed at 24%, or will the entire $200,000 be taxed at 24%?
Good question. No, it is a graduated tax scheme. So the income up to $38,700 is taxed at 12%, and then the income between the $38,700 and the $82,500, the next rate, is taxed at 22%, and then so on and so forth. So it's only the amount in between each top of the tax rate threshold that gets hit with the new higher rate.
Gotcha. Thank you for that. A question about losing animals to severe weather. For example, Hurricane Harvey was brought up. Are there anything that you know in particular to such weather extremes that farmers should know about?
Well, it depends on the type of animal. I think, as I mentioned, certain animals, when you lose them, you're going to deduct them at cost, particularly if they were animals for resale. But animals that are normally depreciated, such as dairy cows, you're going to, if you lose that animal, your deduction will not be the cost, but the depreciated value. So it would depend how many years you've now owned that animal before this calamity occurred.
Thank you for clarifying. Question, rental income for an LLC can use a Schedule E, or must you use a Form 8825?
No, you can use Schedule E.
Okay. Is there a limit on the number of years you can carry a loss forward?
No, not currently. The new tax law was clear that there's no limit, and part of the reason that they got rid of any limit on the carry forward is because the new tax law eliminated any carry back of a tax loss or an operating loss. And
a related question is, can you skip a year? So, for example, if you reported a loss in 2016 but didn't apply it in 2017, can you use it in 2018?
Almost never.
Okay. But if you had taken it in 2017 and there was still some left over, then you could continue to use it in 2018.
Yes.
Okay.
Yes. There is one caveat, though, to the net operating loss for farmers. If the farmer is receiving a federal subsidy, and it depends on the subsidy and how much, their net operating loss may be limited to the lesser of $300,000 or their I think, gross income.
Okay. Well, another question about operating losses. The statement is made, a lot of farms are probably going to be reporting another year of loss. Is there an issue with farms that report year after year? Is there anything that farms can do to protect themselves from IRS if that's the situation?
Even though I don't have a vast amount of experience with preparing tax returns for farmers, though believe it or not, even here in New York City, I have had clients that own farms. They don't have their farm in New York City, but where the IRS is very strict on losses reported in multiple years for other businesses that are reported on Schedule Cs, they're pretty lenient with farmers because the IRS knows that farming losses aren't necessarily just because you didn't manage well or because it's really a hobby. I mean, there's so many factors in farming that the IRS knows are not within the farmer control, like weather, like disease of animals, so on and so forth, that they do not usually have the same 2 and 5 year rule for deducting losses that they have for other businesses.
That's good. That is good information. So question is, how should we expense an item that does double duty on both the farm and the house? For example, a mower for the farm pasture is the same mower for the front lawn.
Good question. Usually the rule of thumb when a piece of equipment has a double use like that, it needs to be at least 75% used for the farming business in order to get the deduction. So that would include vehicles as well as tractors or mowers, such.
Thank you. Question about B corporations, which were mentioned. Is that something to take into consideration?
What did you say?
B as in boy? Is there such a thing?
There is, and I have to be honest with you, I am not that familiar with B corporations.
Okay. So a question about the timing of deduction for a livestock purchase. So here's an example. Suppose I buy 10 weaned pigs in the spring, take them to the butcher in the fall, and start selling the meat from my freezer. By the end of the calendar year, I will have sold some of the pork, but not all of it. Which tax year should I deduct the cost of buying the pigs?
That's a very good question. I would say that you'd have to prorate it, depending on the percentage of meat that you sold compared to how many pigs you purchased in that year.
Excellent. Okay, so I'm going to just take one more question. Let's see here. Question is about children's. Okay, we'll do about this one. How are tenant housing expenses classified in Schedule F? And is this considered income to the tenant, which needs to be considered for withholding, et cetera?
Good question. Good double question. It is considered rental expense. Well, for example, if the farmer has to rent premises for his hired help or her hired help, that rental cost would be deducted on line 24 of Schedule F. If the farmer already owns the property, then that would be other costs on line 32 of Schedule F. And in terms of whether or not it's income to the hired help, it usually is not. There is a rule in the Internal Revenue Code that says if the employer provides housing for an employee as a requirement of their employment, meaning they want the employee to be on the premises, to be available, and to be in a particular spot, then that housing is not considered taxable. The value of that housing is not taxable income to the employee. That's for an example. That's how college president housing has become a big perk, and it's not taxable income.
Interesting. Wow. Okay. I know that we did receive a lot of other questions that we weren't able to address, a lot of specifics about different deductions, but just so folks know, I will be sending out an email later today with links to this presentation and a link to Tina's website as well. Before we do sign off, I have a few housekeeping items. So you will be asked to complete a very brief survey upon the completion of this webinar. If you could take a minute to tell us about your experience, it would really help us for future webinars. And like I said, a recording of the webinar and the slides will be available very soon. They will also be archived on our website and shared over email, hopefully by the end of the day. We do have quite a few other webinars coming up, including one in December about the logistics of meat processing. Rebecca Thistlewaite of the Niche Meat Processor Assistant Network will discuss the ins and outs of getting your animals processed into sellable meat for different market channels. So I'm hoping that you'll join us for that one, and then lots more coming up in the winter. Tina, do you have any parting thoughts before I close this webinar?
I do. Just a couple things that for those farmers that prepare their own tax returns, I highly recommend downloading on the internet for free publication 225, that's the Farmer's Tax Guide for 2018. And another site that I would imagine a lot of you are already familiar with is www.farmers.coop.com, which has a lot of great information on depreciating and valuing your livestock if you haven't already looked on those websites. And for those of you that have your tax returns prepared by an outside professional, I will say again, I highly recommend, even if you only do it once, to sit down with that tax professional and ask him or her to go over your Schedule F and how they came up with the various streams of income and deductions for your farm. Because sometimes if they don't ask the right questions, you may be missing out on a lot of expenses that are very valuable to farm operation.
Thank you for mentioning that, Tina. And I will include links to both of those, the publication 225 and then the depreciation page as well in the email that I send out. So on that note, I'm afraid that is all the time we have for today. A very sincere thank you to you, Tina, for your really fantastic presentation and then for taking the time to answer all of our questions. Thanks to all of you out in the audience for your continued attention and interest. And I hope that you all have a wonderful afternoon and that we're able to connect again soon. Goodbye.